Hello and welcome to Commodity Champions. I'm Manisha Gupta, and it clearly has been the crude prices which has been up and about in this week, with putting in nearly 4% of gains. $61 per barrel for Brent is how we are trading, and the strength has come in on the back of various factors. It has been about US and China, the decline in US inventories, and of course the markets also are looking at demand picking up as we move forward, at least in the Asian markets, and those are some of the factors which have been keeping the crude oil prices alive. But joining us on Commodity Champions are our champions, and we are joined by Ravi Narayanaswamy and Eramo from IHS Markit. Gentlemen, thank you so much for joining us today. Ravi, I want to begin with you. And we've seen crude oil prices continue to be very, very volatile. What is your sense now when it comes to the supplies? Because US on one side, we've seen the production hit a record high of 12.5 million barrels in the previous week. But on the other side, the inventories have declined quite sharply. How do you read both of these numbers?
Thank you, Manisha. It's a pleasure to be back on CNBC-TV18. You're right. There are a few things which is happening in the market. One, the supply side, you're absolutely right. The supply from US is expected to increase further. With the commissioning of 2 new pipelines. The entire thing was the bottleneck in the U.S. was the offtake capacity, which is going to be alleviated by this commissioning of the 2 pipelines. And also, you're right in the sense the inventories did drop. One of the key things what we see in the 4th quarter of 2019 and moving all the way up to first half 2020, with the change in the regulation on the bunker fuel specification, if you look at the refining industry and the shipping industry, they are not really ready from a total perspective to handle the specification changes. So because of that, what we will be seeing is a pull on the gas oil, diesel part, which has to go as a bunker fuel instead of a bottom of the barrel residue. So what that translates is to incremental crude runs. And that's one of the things what you have started to see in the market is there is a pull on the crude runs to be prepared for this inevitable change in the gas, in the bunker fuel specifications. So those are the 2 factors. And then, of course, on the negative side, the US-China trade sanctions. That is always going to be up and down in the market. And then also the current situation in Iran, the Strait of Hormuz, where the tanker wars. So any such ignition out there, that is going to have a negative sentiment on the crude oil prices. Yeah.
Markets, not just the crude oil, the chemical industry capacity also has been increasing, and there are various other factors to look at. Lower profitability is one part of it. The kind of investments that we are seeing is something that has been increasing really, at least in India. How are you sizing the sector as of now?
Again, thank you, Manisha. Good to be here with you. From a petrochemical standpoint, again, think from a standpoint of both a build cycle that's driven by profitability and then a demand pull that's driven by economic growth. So the profitability for the last 3 to 4 years has been very good, and that has stimulated reinvestment. Okay. So from India, across Asia, and on up into China, and really the Asia-Pacific region really represents the area of the world that is both building the most capacity, 60% of the new builds, and also consuming the most product, maybe 50 to 60% of the demand growth. So as the economy grows, and while we are certainly seeing a slowdown, the profitability of the last 3-4 years has led to this reinvestment that is occurring, again, across the region. So we do see significant new capacity build. Unfortunately, as we are also now calling for a little bit slower economic growth, that will create a little bit of surplus capacity in many markets, which will then take us into this reduced level of profitability that we've really been experiencing in Asia since the end of 2018.
Oh, well, yes. Mark, also the kind of investments that we've seen, the interest in investments from companies like BP or Shell or Saudi Aramco, for that matter, in the petrochem as a business. How are you reading into those numbers? What kind of demand growth are you expecting within India?
So the Indian market is one of those markets that looks very promising, again, especially from an economic standpoint. As the economy continues to grow and as you look at infrastructure investments, what that means is you need, basic chemicals for both durable and non-durable goods as well as construction products. So the demand growth from a standpoint of petrochemicals, the outlook remains positive from an India perspective. Seeing these other, I'll call it oil companies, take interest in petrochemicals is really one signal of the outlook for a flattening of refined product demand growth in the future. And so we are seeing more oil entities, refining entities, look to petrochemicals as a potential growth vehicle for the future. And from an India perspective, again, it's on balance, a major net importer of base chemicals and commodity products. So building in India in many cases, in many value chains makes good sense.
No, it absolutely does. And while we are on the topic of economic growth, Ravi, this one is to you. I remember last time we spoke, you'd said that the demand growth that we are seeing, especially from Asia, comes mainly from China and India. But we've seen Indian demand growth actually continue to decline in the last 3 or 4 years. Where do you see it standing right now? And do you see stability now? What number are you working with in sense of demand growth?
From an Indian perspective, what we are expecting is, yes, over the next couple of years, it is going to be around the same levels as what we are seeing. So beyond 2022 onwards, with the government's push on electric vehicles, especially in the two-wheeler sector, you will see that the new two-wheeler sales, you will start moving more towards electric vehicles. So because of that, you will have an...
But isn't that still...
it's still a long way.
Yeah.
It's still a long way. But what I'm saying is slowly you will start seeing that the growth rate, whatever you were seeing, typical growth rates will start slowly trending down.
Okay.
And the key point to note is the gasoline demand in India, 60% of it or 60 to 65% of it is coming from the two-wheeler segment. So that shift in the mix of electric vehicles compared to the conventional ones, and then also because of the scrappage rule which is coming in, you may see that more and more push toward the electric two-wheelers will start having an impact. You're absolutely right, not in the immediate term, maybe by end of 2020s, early 2030s, then you'll start seeing some slowdown in the growth. But Ravi, we are not expecting any sort of peak demand growth in India over the next 15, 20 years. No.
So are you looking at 3 to 5%? Are you?
Yeah, on the overall basis, yeah. Yeah.
Okay. Ravi, for some time, we've been talking about the IMO 2020 regulations kicking in from 1st of January. But suddenly, with this whole weakness in demand, the economic slowdown, it really seems to have dampened moods. And not too many people seem to be talking about that anymore. What is your sense to the run-up to 1st of Jan, and how does it change the world?
See, the key thing is, if you look at how you can supply this the stringent specification fuel. One is the refining industry has to put investments to handle that part. From what we have looked at is the refining investments, whatever is needed to take care of the specification changes, it's not adequately being invested. So then the other part is the key variable in this specification changes compared to other ones is it involves two industries, refining industry and the shipping industry. On the other side, the shipping industry can handle that by treating the exhaust gas and then making sure that the emissions which eventually go to the environment meets the specification. Even in that, we are not seeing that enough investments are made into the shipping industry.
Okay.
So given this, what we see is in 1st January 2020, when the specification changes comes in, it's going to be a major disruptor. The other key variable is IMO from its, IMO stands for International Maritime Organization. They are doing all sorts of, they are devising some smart ways to make sure that the enforcement and the compliance is going to be at a high rate. So because it's going to be difficult to comply in the outer seas, they are trying to look at as far as possible control it at the loading ports. So there is a lot of things going on in terms of the compliance issues also. So given all those things, what we see is there is going to be a huge disruption. The high sulfur fuel oil, which is primarily the bunker fuel today, it will not be taken up by the shipping industry. There has to be a replacement to that. And then some of the refiners are finding different blends to make sure that the lower sulfur specifications are met. But in spite of all that, we see that there is going to be a pull on marine gas oil.
Okay.
And the marine gas oil, whatever has to be pulled, has to be supplied by the refining industry by running incremental crude runs. That goes back to my point, saying that we see from now till mid-2020s, there is going to be a pull on crude, which will, in a way, act as a positive sentiment for the crude prices. But granted, it may or may not be a great thing for from an Indian perspective. So, yes.
So, as we talk about environment and as we talk about changing, the changes that are coming around in the world, Mark, how do you look at the whole carbon footprint, the plastic waste management, because that is also making headlines, not just in India, but much part of the world. How do you see the whole balance shifting then when it comes to petrochemicals?
Great question, and you're absolutely right. It is truly a global issue. So I spent a lot of time traveling, through the Americas, Europe, Middle East, across Asia Pacific, and there isn't anywhere that I go where sustainability, carbon footprints, and plastics waste aren't really at the kind of the top of the list in terms of what gets discussed. So on balance, if you a couple of perspectives on this. So one is, in every country of the world, I think in terms of this balance between economic development and the investment in this petrochemical sector, right? It's what we call the enabler of modern life. It allows you to go from a barrel of crude oil to finished goods, consumer goods. And that brings economic development. And then that being balanced with what I call the social license to operate, right? People, everyday people, right, looking at their backyards, looking at the environment and saying, what are you doing to protect the environment? And so all these issues are being discussed around the world, and it's that balance I'll say, the social issue, the social license to operate, that has really been thrust into the headlines starting in 2018, especially from a plastics waste issue, and of course the carbon emissions issue has been there for some time. But in 2018, really the plastics waste issue was almost, louder than what was happening from a carbon issue and a climate change issue. So from a petrochemical standpoint, on balance, what happens here is you think of, if there will be less plastics consumption, then you start to impact historical demand growth trends that we've seen over the last 2, 3, 4 decades.
What is your sense on supply, demand, and crude prices moving ahead from here?
So from a demand perspective, what we are seeing is year-on-year growth in demand in 2019 globally. We are talking about close sub 1 million barrels per day. Just to put this number in perspective, it is about 60% of what was the growth last year. And then this is almost near the lowest what we have seen since the global financial crisis. So that's because of the weaker economic sentiments. We are seeing that the global economy, in our view, is expected to be 0.5% to 0.7% lower than last year. Then from a supply side, like we spoke about, U.S. supply is expected to grow on. We are expecting, on an average compared to last year, 1.5 million barrels incremental U.S. supply.
So if the non-OPEC supply will continue to increase, do you think OPEC will have to actually go forward and cut some more from where they are right now?
The question comes in is, if you look at the Vienna Alliance, they have already cut about 1.4 million barrels per day compared to what they were producing in the end of 2018. And then more than that, this excludes whatever outages you have in Venezuela and then the Iranian drop in production. But if you look at it from their fiscal break-even point of view, that is also coming back to bite them. So the question is how long and then how deep they can cut further. So from a pricing perspective, the positive sentiment, like we spoke about the IMO regulation, so that's going to have some upward momentum. All in all, we see the prices in the band of, say, 60 to 65, 66 range.
For this year and the next, or do you think next year is going to be even more bearish?
I think more or less for the average for from now to, say, the end of next year, that's the number we are playing with. Because we see that the initial disruption, maybe after 6-7 months of the next year, we'll start seeing some stability in the spec change in the IMO regulation point of view.
All right. Ravi and Mark, thank you so much for coming by, and thank you so much for that conversation. Well, with that, let's go for a short break. When we come back, we'll put the spotlight on precious metal prices.